now we'll open it up to Q&A. So if you would please. Okay, first question. Any concern about the falling GDP trend of Japan? Not necessarily. Japan is actually getting all types of credit and sort of like, high fives for their success. So Japan is a very healthy economy. Their consumer is healthy. Falling GDP is, you can, when you go from a high point to something lower, you can say that that's a concern, but their GDP is still in a very healthy place. So overall, when we participate on these calls, Japan gets like a check mark. There's always like, Japan is strong, Japan is strong, Japan is strong. So Bryan, let me get your input. What are your thoughts about Japan and any concern about?
I'm really none. I mean, their I'm sorry, their inflation rate's around 2.8%. So they've not experienced the effects of inflation like a lot of the other developed markets are concerned. Of course, their interest rates have been low. Now, granted, they've been kind of moving in the opposite direction as everybody else. So they may increase their inflation rate. I'm sorry, their interest rates a little bit as other developed markets are decreasing the rates, but I've not really no real concerns as far as the GDP or the Japan economy in general.
What we're doing and this feedback, for example, the sum up at the end, that was feedback. So we'll do the presentation and we do the sum up. That's by design based on feedback from you. You may have noticed we zoomed in on the charts and to make the images bigger, that was feedback. Those are some of the changes that we're making. Here's our next question. Any estimate on when we see relief in consumer prices? What's the lag time if inflation is leveling or falling off? Bryan, let me let you start with that. So question, let me repeat it. Any estimate on when we will see relief in consumer prices?
Yeah, as far as I guess the way I interpret the question is decrease. I mean, as far as decreasing consumer prices, I'm not sure if that's really going to happen. I mean, it's with our wage growth going, well, it's still healthy, it's going down. I think the consumer prices are probably won't be going back, decreasing back to the levels that we saw make pre-COVID, but at least the price relative to wages is now kind of at a inverse relationship now, as far as at least income. Americans are seeing more income than they are increase. But as far as going back to pre-COVID or previous level prices, I'm not sure if that's really going to happen. I don't know,
Yeah,
Chris.
I would agree with you completely, which is for when we were experiencing inflation, it was very obvious that every time we went to the grocery store, things are more expensive. Every time I buy an apple and it costs me $1, I'm still surprised. And so on Monday, I went to Kroger and I got 5 apples. And sure enough, $5. And so the difference being, to Bryan's point exactly, is that wage growth is now growing, and even Social Security increase at 3.2%, a higher rate than the cost of prices rising. And so to your point, the question says, what's the lag time if inflation is leveling or falling off? That's the reason why the Federal Reserve does not want to lower interest rates anytime too soon. So we have interest rates where we are. We do not need to rise interest rates anymore. And quite frankly, we do not need the news media making a big sticking point about the fact that they didn't lower them. There's no relevant argument there. The interest rates are where they are, so inflation continues to come down. If I were to guess a lag time, 9-12 months. I mean, I wouldn't be surprised if interest rates don't go down until after July. And quite frankly, if I had my choice, that's when I would want to see it. And all in the meantime, I just have to listen to the blah, 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 and just quietly disagree. Very good. Okay, next question. Any concern about the effects of the war in the Middle East on the global economy and the US in particular? So, great question. It's not a concern as it relates to your investments and as it relates to the overall growth in the economy. So or even global economy. So we pointed out the fact that these ships, the Houthi rebels are right in that corner as you head into the Red Sea. So they have that corner of Yemen. And we're seeing shipping deliveries slow down. Tesla even mentioned they're not delivering their cars as much because it's taking longer amount of time for them to get the material to finish building the cars. It's really a humanitarian issue. So things like the innocent people in Palestine, that's horrible. No one agrees with that. But when you have bad guys standing in front of innocent people, it's just horrible. So it causes a huge divide. There's a lot of friction with Iran supporting even other groups like Hezbollah and what we saw in Jordan on Sunday with 3 of our US soldiers passing away. So it's a human issue. It's not an economic issue in the sense that it won't negatively permanently affect your financial plan. But it causes friction even in the US. It's like, are we gonna send money, and how are we gonna deal with this situation? Coincidentally, I'll make this last anecdotal comment, and Bryan, I'll turn it over to you. I attended a lunch it was a late lunch on Monday with a retired rear admiral from the Navy. And one of his comments about this Houthi situation is that we moved one of our aircraft carriers within 18 hours right into that area. And so just because we don't respond every time we have something is sent doesn't make us weak necessarily, but we have the most powerful Navy in the world by far. And that is not something that gets talked about very much. So I was felt lucky to be able to attend, and the strength of our Navy and the amount of the budget out of all the military branches, the amount of money that goes to the Navy is greater than the others because the world is covered 70% in water. So we spend a lot of money on our Navy for all the right reasons. So Bryan, thoughts about global conflict? What are your
No, I mean, there's nothing really more that I can add. I mean, obviously, if something really escalated and got more involved, that's a whole nother situation. But as far as how things currently stand, I mean, I totally agree.
Next question. What are your thoughts about the devaluation of a dollar with our current and rising debt? I'll jump in on this one. So the dollar devaluing is another one of those inverse relations. So I'll try to keep it concise. The dollar devaluing is not necessarily a bad thing. And over the summer of maybe 2 summers ago, the dollar was very strong. The dollar being strong is not like a muscle thing. When the dollar is strong, what that helps is when you travel to Europe and you go to Europe and you're buying things and your dollar is buying more. It's less expensive when you go to Italy and you're buying lunch. Your dollar is more powerful to buy those local currencies. It actually restricts trade. It makes it less attractive for companies to trade with the US. A strong dollar. A weak dollar actually increases international trade. So this idea, and I love this question because this is another example of the news media trying to take a word or a term to say the dollar is weak, and as if it has anything to do with the strength of our country. it does not have anything to do with the strength of our country. It has to do with how much can you buy and how does that translate? So it helps when you're traveling internationally because you can buy more with your US dollar. The rising debt, is it's a concern in the sense that we continue to run a deficit. However, the interest in our government bonds is very high. We have no concerns. Well, let me say this differently. US corporations and foreign governments are very interested in buying US treasuries. And this was a point on the JP Morgan call earlier this month. In December, and back to the seesaw, in December, there was a lot of government bond buying to the point where when you have a lot of buyers, the price goes up. So people are buying, buying, buying. Well, here comes up the price. What happens with bonds? The price is rising, the yield goes down. So in the month of December, the yield for government bonds was going down because there was so much demand for US government bonds. So the fact that we're financing $1.7 trillion is not great. The demand to buy those bonds is reassuring. So good. I think we answered that. Your thoughts about Bitcoin being traded as an ETF, further of Bitcoin as part of the mix that you'll be proposing. So I do not foresee buying Bitcoin. Bitcoin, there is some functionality to Bitcoin and cryptocurrency if or as it becomes used in trade. That is less so now. So truthfully, you could make a case to say that Bitcoin is actually worthless, totally worthless. There is some technology behind it. So there's value in the technology, but whether Bitcoin is worth $25,000 for one coin or $45,000 for one coin is not relevant in our opinion. And it is not expected to be, we will not be adding Bitcoin to any of our portfolios. And I think long-term, it may end up being something to the effect of the tulip craze, the beanie babies, things that we'll look back 10, 15, 20 years from now and say, you know, we're not going to be engaging in the idea of what is the value of the price of the Bitcoin. Bryan, let me get your input.
I mean, the same thoughts till it becomes something that's used. I mean, granted, there's spot cases where Bitcoin is accepted as a payment, but it's very far from being widespread. I don't really see that being anything tangible that we would look at putting into the portfolio. And also, Bitcoin really is still, I mean, granted, regulation has picked up a little bit on it, but it's still very much unregulated as far as investing is concerned and how it's treated, and short-term long-term capital gains. So it's one of those things that's still a work in progress from various aspects, from a regulation standpoint, but also just like I said, like you mentioned, Chris, from a use and trade perspective, as something that's tangible and more widespread as far as its use as a monetary value.
Okay. Next question. Are there any other sector specific strategies that you're considering? So we look at the various sectors and trends. So for example, during COVID, tech went fantastic, which was expected because, we were all in quarantine. And well, then what happened? 2022, a lot of gains were given back. And then 2023, tech did well again. So we identify these trends, but we don't want to be, it's like we don't want the tail to wag the dog. And so we notice we're aware of trends or even dividend, how dividends are influencing in the portfolio. Or I mean, talk about different sectors. All those bonds, I'd say the most that we're applying, and we didn't get into the weeds on those bonds. And I can show that chart, but there is a whole additional subsect. There's probably 10 different sectors within fixed income, within the bonds that we can buy and add to the portfolio. So I'd say the answer is yes. And maybe I should share that screen. This is where we are the most focused here. What sectors within the fixed income are we adding? And over the next 2 years, as interest rates rise, how are we applying what we know will happen? We don't know exactly when, but over the next 2 years, interest rates will be declining. And how are we applying these sectors within the fixed income to your portfolio? So a little bit of a different question in the sense that it's not equity for the most part, but within fixed income, we're very focused in this area and how you're how that relates to your portfolio. Okay, next question. What should we expect in terms of market volatility this year being an election year? That's hard to say. Last year was what I thought was a volatile year, but it wasn't. I'm actually going to show this other chart because it was less volatile than I expected. So let me share this page. Great question on volatility. So this is the S&P 500 and this is 2023. The volatility is defined as 1% up or down either way. And last year came in at 64, which is just the exact average. I think it's too soon to tell. I don't have the number for the month of January necessarily in terms of volatility. 2022 was a volatile year. And so we can include this chart and send it to everybody. But this was interesting that came up, in our process of preparing for the presentation, is that last year was very much average from a volatility standpoint. And I think over the last few years, we got used to having lower volatility, and then we experienced volatility again 2 years ago. And so I think it's too soon to tell. Thank you for your participation. Thank you for your questions. It's an honor to work for each of you. We're going to be hosting this event at the final Wednesday of each new quarter. So you'll be hearing from us because you're registered. If you have a conflict, you'll always get the playback from us. And we look forward to another great year. Thanks so much. Bye-bye.